If you're following our Global Economic Outlook series, hit subscribe to stay updated with new country releases. What happens when an economy stops moving? In 2025, Greece faces economic stagnation where growth, jobs, and investment all freeze. Are we witnessing the signals of an economic freeze? Greece's economy entered a period of pronounced stagnation in 2024 and 2025, with sluggish gross domestic product growth, persistently high unemployment, restrained monetary policy, modest inflation, and a severely elevated debt burden. These factors reflect residual structural vulnerabilities from the debt crisis and limited momentum in recovery. The gross domestic product annual growth rate remained weak. Full-year growth held at approximately 2.3% in both 2023 and 2024, which is modest given Greece's potential output gap. In the first quarter of 2025, seasonally adjusted gross domestic product showed no expansion, indicating stagnating momentum. Projections place gross domestic product growth at around 2.5% for 2025, an improvement, but still moderate and insufficient to signal a structural break from stagnation. The unemployment rate remains elevated relative to European Union peers. National unemployment declined slightly from 10.3% in 2023 to 9.3% in December 2024. Before rising to 9.7% by May 2025. For the 20 to 64 age group, unemployment averaged around 10% in late 2024. Youth unemployment among individuals aged 15 to 24 remains particularly high, exceeding 20%. These figures denote persistent labor market slack despite modest gains in gross domestic product. Interest rates in Greece mirror Eurozone policy. The European Central Bank's benchmark rate in early 2025 stood at approximately 4.5%, with domestic lending rates at roughly 4.5% as well. Credit to non-financial corporations was reported to grow at around 17% year-on-year by April 2025, the strongest pace since 2009. However, the transmission to broader household and small and medium enterprise credit remained limited, reflecting both demand weakness and cautious bank behavior. Inflation has moderated but remains slightly above the European average. Headline inflation rose to around 2.6% in December 2024, then eased to 2% by April 2025, the lowest rate since late 2023. Core inflation, excluding food and energy, hovered around 3.5%, reinforcing price stickiness in services and housing. Energy and food price components continued to exert upward pressure, even as headline inflation eased. Debt to gross domestic product ratio remains Greece's central macro vulnerability. Government debt stood at approximately 153.6% of gross domestic product in 2024, down from around 163.9% in 2023, but still among the highest ratios in the European Union. Projections for 2025 anticipate a gradual decline to around 149%, based on continued primary surpluses of 2 to 4% of gross domestic product and modest economic growth. Nonetheless, debt servicing costs remain elevated, constraining fiscal space and limiting expansionary policy options. These indicators collectively portray the environment of economic stagnation. Gross domestic product growth moderate at around 2.3% in 2023 and 2024, stagnant in early 2025, projected around 2.5%, unemployment high at around 9.3% in late 2024, rising to around 9.7% by mid-2025. Interest rate around 4.5% domestic lending rate, aligned with Euro policy. Inflation around 2 to 2.6% headline, core inflation around 3.5%. Debt to gross domestic product around 153.6% in 2024, projected around 149% in 2025. Several sectoral and structural conditions underpin this stagnation. Domestic demand remains weak, household consumption is underwhelming, and fixed investment remains subdued. While credit growth among large corporates has picked up, this has failed to translate into robust investment for small and medium enterprises and public infrastructure projects. Consumer sentiment remains fragile due to high unemployment and wage stagnation. Labor market rigidity limits employment growth. A large public sector dominates wage employment, discouraging new private sector entry. Youth and female labor force participation remain constrained. Graduate unemployment remains persistent in certain fields due to misaligned education outcomes and limited private sector demand. Monetary policy flexibility is restricted by Euro membership. While interest rates have eased modestly, effectively stimulating credit remains a challenge. Legacy fixed-rate mortgages limit the pass-through of monetary easing. Meanwhile, elevated interest rates restrain new borrowing, particularly among households and small and medium enterprises. Persistent inflationary subcomponents. Although headline inflation has declined, core inflation remains high due to structural pricing patterns, rigid labor markets, and persistent costs in food, housing, and regulated services. Debt legacy and limited fiscal maneuverability. Despite ongoing reduction in debt to gross domestic product, Greece's debt levels far exceed Eurozone averages, limiting scope for fiscal stimulus. Primary surpluses offer long-term balance, but high debt servicing costs leave little flexibility for investment in productivity-enhancing sectors. Exports and tourism provide moderate support but lack scale. Tourism and exports contributed new impetus in the fourth quarter of 2024, with net exports adding modest gains to gross domestic product. However, tourism remains vulnerable to external shocks and is insufficient to overcome weak domestic demand. Prominent risks to Greece's recovery include slow structural reform, particularly in public administration, labor regulation, and public procurement. Demographic pressures from an aging population and low labor participation. External shocks such as Eurozone slowdown or contagion from other debt crises. High debt levels that amplify fiscal risk in the event of economic or financial stress. To escape stagnation, Greece must pursue a multi-pronged policy agenda. Rapid implementation of structural reforms to reduce regulatory burden, streamline public administration, and incentivize small and medium enterprise growth. Focus on private investment, especially through credit access to small and medium enterprises, public-private partnerships, and capital market development. Activate labor market participation, particularly targeted training and placement policies for youth and women. Diversify exports beyond tourism by supporting innovation in technology, green energy, and higher-value services. Maintain fiscal discipline while reallocating spending toward productivity-enhancing infrastructure, digitalization, and human capital. Leverage tourism, modernization, and infrastructure investment to support regionally balanced growth. Strengthen governance and transparency to build investor confidence and encourage both domestic and foreign investment. If these measures are pursued, Greece could achieve moderate gross domestic product growth closer to 3%, reduce unemployment modestly, maintain inflation around 2%, and gradually reduce debt toward 140% over the medium term, establishing stronger economic footing. In conclusion, Greece's economic condition in 2024 and 2025 exemplifies stagnation growth at or just above trend, high unemployment, moderate inflation, restricted policy flexibility, and heavy debt burden. While not in crisis, the economy lacks dynamism. Unless structural transformation accelerates, Greece risks remaining locked within a low productivity equilibrium, limiting improvements in living standards and future resilience. For more data-driven insights and global market breakdowns, subscribe and turn on notifications. Stay informed, stay ahead. This is Economics FX, where clarity meets strategy. Until next time, trade smart.